Coming up in today's show, stocks trade mixed on little news, Microsoft closes at an all-time high, why we may not get a Santa Claus rally, a look at the Q3 earnings season, the ongoing risks from the bond market, oil falls below $80 a barrel, and why I think small cap stocks are set to outperform. Hey, welcome back everybody. Thank you for tuning in to the Click Capital Daily Market Show. I'm your host Jared, and I'm going to get you all up to date on the most important news, data and charts across financial markets. And it was a bit of a mixed day on Wall Street. We don't have a whole lot of news coming out this week, getting to the back end of Q3 earnings season. And once again, it was mega cap tech, trading like its own asset class and leading the way up today, while we continue to have a bit of weak breadth across the rest of the market, namely in smalls and in energy with those falls in crude, which I'll get into a bit later on. And just looking at the daily chart of the S&P 500, we could be stalling out a little bit here, just below 4,400, where we ran into resistance in the middle of last month. And we've got a bit of a trend line above us. And we can see it was the NASDAQ today, the winner, up almost 1%, and actually broke out above this little mini trend line we were watching, and just put in its 7th consecutive winning day. And stick with me because I'll come back into these main indices a bit later on in this video. First, let's just take a look at small caps, which were down again today, with the Russell 2000 sitting right at the 50-day VWAP. And one area of the market I've been interested in lately, micro caps, been hit really hard. And just taking you out to a clean monthly chart on the microcap ETF under the ticker IWC. And we are down more than 40% from peaks we reached in the middle of 2021. So microcaps have been in a bear market for the last 2 years, and we're now trading back at levels we were at before COVID in late 2019. And if you compare that to the chart of the S&P 500, you can see the stark difference there, and even more so in the NASDAQ. And just looking at the spread of microcaps versus the S&P 500, so the smallest stocks in the market versus the largest stocks in the market, you can just see that huge underperformance of microcaps versus large caps. And that spread is at the lowest level it's ever been since the microcap ETF IWC came onto the market back in 2005. And that's not a normal pattern. That doesn't occur all the time with large caps significantly outperforming microcaps. It's been quite an unusual decade of underperformance from microcaps. And looking back through history in the long term, it's actually small cap value that on average delivers the highest annualized returns, as we can see in this chart here. With a growth of $1 invested in small cheap stocks over the last 100 years, that grows to over $100,000 versus large expensive stocks here in the green line. That same dollar just grown to over $10,000. And here's another chart to show where we are. This here shows the earnings yield spread of small cap value versus large cap growth. It's currently near an all-time high. So if a stock has a PE of 10, that's an earnings yield of 10%. A PE of 20 would be an earnings yield of 5%. And so currently the spread between the earnings yield of small cap value stocks is 21% higher than that of large cap growth stocks. And looking back through history, we've only seen that 1.7% of the time. And in the 10-year periods following those past observations, small cap value stocks have returned a huge 16.8% a year more than large cap growth. So basically, we're setting up really fertile ground to invest in small cap value stocks, and they should significantly outperform large cap growth over the coming years, as large cap growth has come off a huge outperformance the last couple of years, especially since COVID. And it's a similar story with dividend paying stocks as well. And again, in the last couple of years, non-dividend paying stocks have significantly outperformed dividend paying stocks, and that too could go through a huge reversion to the mean in the coming years. And believe it or not, looking back in history, small cap stocks actually outperform large caps when we see a rise in the unemployment rate, as they've tended to bake in recessions ahead of time. And we can see that in this chart here of the dark blue line showing the Russell 2000 relative to the S&P 500. Overlaid with the light blue line is the unemployment rate. And so we can see the spread of the Russell versus the SP rise numerous times at the same time the unemployment rate rises. And so because of all of that, the huge underperformance of micro caps, the smallest stocks in the market versus large caps, I've been bargain hunting lately, and I've come up with what I think is my best pick this year in the micro cap space. And I've actually just recently invested 12% of my long-term portfolio into this stock. It's a micro cap under 300 million market cap that trades on the first tier over-the-counter OTC exchange. So there's 3 different tiers of OTC stocks. The first tier are your real high-quality names with more reporting requirements, and even have some of the largest companies listed on there around the world like Tencent, Heineken, BHP. Then you got the second tier, venture stocks, which have less reporting requirements, less liquidity, a bit more risky. Then you've got the dirt of the stock market, the pink sheets, the bottom of the barrel stuff. They have no reporting requirements and a lot of scams going on there with penny stocks and such. So this is not a penny stock. It trades above $10 a share. It's actually very profitable in a high growth industry. They pay a quarterly dividend with a yield above 10%. They have a strong balance sheet with a net cash position and almost no debt. Really competent management that have millions themselves invested in the stock, are some of the largest holders. And they believe the stock is undervalued. That's why they're buying back the stock in a share repurchase program. And the stock's currently trading under $15 a share. I've actually got its net asset value around $20 a share. Its liquidation value, however, taken into account future earnings, my fair value model says it's worth closer to $50 a share, and there's a few catalysts which I think it could reach that in the next 1 to 2 years. And one of those catalysts being that it is an OTC stock and it could potentially be uplisted to the NYSE or NASDAQ over the next year. And that allows the big institutional money to invest into it, and we should get a material repricing if that were to happen. And so tomorrow night I'm making available for purchase a 45-minute special presentation video I've been working on the last couple of weeks. I put a lot of work and effort into. It's a 27 slide deck plus accompanying research material where I do a deep dive into the industry, business, management, balance sheet, financials, valuation, risks, and technical analysis. I'm going to show you my investment objectives and investment plan with it. I'm only charging a one-time fee of $59 for immediate access to the presentation tomorrow night. And included with that is periodic updates from me where I'll keep you updated on the stock, what's going on in the industry, how the business is progressing, and specifically my investment in it, whether I've added any more shares, reduced, and when I do finally exit. As I'm looking to realize the full value from that stock, I think it's really undervalued and it's got everything going for it. And like I said, micro caps have been hit really hard this last 2 years and is offering up some really good bargains for the willing and patient investor. And so just a little bit about me if you don't know already. My name's Jared, that's me there in my trading office. I grew up in Australia. I have qualifications in the financial industry. I worked for Australia's biggest investment bank, Macquarie, from 2006 to 2008. I love trading and investing. I think it's the best game in the world. Been doing it for 20 years. And ever since I resigned from Macquarie in 2008, I've been working for myself. And apart from my own trading and investing, I'm focused on growing my online business, Click Capital, and run the daily market show that you're watching now on YouTube. I base myself out of Queenstown, New Zealand, and I enjoy everything outdoors. I also run an active investment strategy on the Collective 2 marketplace. That's called OnlyBears, and this is an independent marketplace where I enter all trades in real time and they track my performance, minus all brokerage and subscription fees to follow my strategy, which is $75 a month. I started on here in December, and in that time I've delivered subscribers a 41% return, currently up 34.6% year to date, with a Sharpe ratio of 1.4 and negative correlation to the S&P 500. And just looking back at a few of the past winners I've delivered to subscribers, back in late February we shorted Etsy at $120 a share, covered it early last month for $63 a share. In July I shorted Mara at $15.69 a share. 3 months later we covered it at $7.50 for a 50% gain, and I had a few winning long positions earlier on in the year as well. Getting subscribers long Medical Properties Trust back in mid-May at $7.38 a share, exiting less than 2 months later at $9.63 a share, delivering subscribers over 30% gain in under 2 months. Back in April we got Long Lending Club at $7.07 a share. Less than 3 months later we exited at $9.76, giving my subscribers a nice 38% gain. However, since I changed my strategy on Collective 2 to OnlyBears and just shorting now, because I'm mostly focused on large caps there, and I think the stock market as a whole, especially from the top down, has a lot of risk over the coming year. I no longer take long positions, plus I can't trade OTC stocks in that strategy. That's why I've made this special presentation to let you know what I've personally recently invested in myself. And so if you'd like to find out what this stock is, along with my 45-minute presentation and ongoing updates, then come back to this channel tomorrow night and I'll let you know how you can get immediate access to that for just the one-time fee of $59. And if you don't feel like you've got your money's worth and a lot of value out of that, then I've no problems in sending your money back. Just send me an email and I'll keep that money back guarantee open for 7 days, giving you plenty of time to watch it and have a thinking about it. However, once you see my research and deep dive, I think you'll agree this is a really special, unique opportunity within the beaten down micro cap sector, and it has a lot of catalysts for why I think it could potentially gain 100 to 200% over the next year or two. So I'm really excited about that, and come back tomorrow night to learn a bit more about how you can get access to that. Just getting back into the regular daily market show, we've got one research analyst saying the S&P 500 could soar more than 20% in the next year, after we just got an ultra rare buy signal. And that's the SWIG breadth thrust indicator, which flashed on Friday after the S&P 500 saw its biggest weekly gain on the year. And as Ryan Detrick says, all you need to know is since World War II, the S&P 500 is higher a year later every single time. And that's the 18th time the indicator has flashed since 1945. And this rare signal is simply stocks moving from very oversold to overbought in less than 2 weeks, which we've just seen, as it represents a sudden and swift improvement in breadth conditions after they've been beaten down. And there's definitely some optimism back out there. We can see that in the shares of Microsoft, closing at an all-time high today, above $360, on the back of another strong earnings result we got a week ago, with their cloud businesses still growing. And just looking at the daily chart here, initially after earnings we gapped up and sold off hard the next day, but found its footing straight away, and so it's been pretty much straight up since then. This current technical pattern looks to be like walking the line, where even though we're technically overbought, there's no real divergence. And this is typically strong price action that's pretty supportive of the stock price. And prior to today, the highest close we got previously was back on the 18th of July at 359. We now got a market cap at 2.68 trillion and quickly closing in on the biggest stock in the market, Apple, at 2.82 trillion. However, just stepping back and looking at the big picture, tech stocks are at record highs versus the S&P 500, even above the peak we saw back in the tech bubble in year 2000. And so tech stocks have just been absolutely smoking the rest of the market the last couple of years, led by the mega cap tech. And while this pattern can keep going on for longer yet, no one can tell when the top is. It has been one of the most persistent and distinctive groups of outperformance I've ever seen in my 20 years of trading. And this is at a time we've got interest rates at 17-year highs. And like one wealth manager says, we should brace for wild swings in US stocks amid these elevated rates and uncertainty. With CIBC Private Wealth saying, while last week was a good one for the equity market, it will not always be that easy. We expect the rest of the year to be volatile, going through manic depressive swings based on where interest rates are headed. Looking ahead, however, there may be a reality check ahead on the Fed. If bond yields continue to fall, will a rate hike be back on the table? We need to keep an eye on this. So whilst there seems to be a strong consensus out there that we are going to get a Santa Claus rally with stock prices rallying into the new year, that may not materialize as many hope. And looking at average seasonality returns from the 1st of November for the last 2 months of the year, on average we can get about a 5% return if October was down and we're up year to date. However, we've pretty much already done all that, with that seasonality giving us a year-end target around 4,400 on S&P 500. So any growth from here would be above average seasonal returns, and the market may have already baked it all in. And even though we're coming off the back of a good Q3 earnings season overall, S&P 500 companies have seen the largest negative price reaction to negative EPS surprises since 2011. We've had 81% of companies in the S&P report earnings for the third quarter. 82% of them have delivered earnings per share above their estimates, which is a bit better than the 10-year average of 74%. And their earnings have come in higher than estimates by 7.1%, which again is a bit higher than the 10-year average of 6.6%. And for companies that are reported positive earnings, they've seen an average price increase of 0.8% the 2 days before earnings through the 2 days after the earnings release. That's below the 5-year average of 0.9% a little bit. However, companies that are reported negative earnings surprises have seen an average price decrease of 5.2%. 2 days before earnings through 2 days after. And that's a lot larger than the 5-year average price decrease of 2.3%. So basically the market isn't quite rewarding companies that beat on earnings so much, but they're more so punishing companies that miss. So this gives you a bit of a taste of the market's mood and low tolerance for companies that are missing. We've seen some big moves, pops either way, coming through with earnings. Stocks up and down 20-30%. Still plenty of volatility out there in individual names, even though the VIX is still really low. And let's not forget about the banking sector, which is still quite vulnerable in case things go pear-shaped. And that's because they have a huge $650 billion of unrealized losses on their balance sheet due to all the bonds they bought during COVID at rock bottom rates. And we're still in the midst of the biggest bear market in bonds in their 250-year history. And that's okay if they can carry these bonds through maturity and retrieve their principal. The problem is, if any more institutions fail or any more systemic risks, and any of those losses have to be crystallized and realized, that'll cause huge losses to equity and bondholders of those banks, and quite possibly the whole economy as well. And just looking at a weekly chart of the regional banking ETF, KRE, that's why it's still down almost 50% in a 2-year-long bear market. And just looking at that price action, that's nothing to get too excited about either. And large financials have been trading sideways for over a year now and not doing anything too exciting either. And that's also catching the attention of Wall Street referee and chief of SEC Gary Gensler, who's sounding fresh alarms on the leverage in the treasuries market. With all this volatility we've been seeing lately, 10 years fallen a huge 50 basis points in just a week alone. And he recently just said we have bank and non-bank intermediaries using leverage, particularly in the prime brokerage relationships. And when stress enters the system, the result can be instability. And so he's looking to introduce more regulation into that market, like he is doing with crypto, with a raft of SEC proposals, from mandating central clearing of all US treasuries, to forcing more trading firms to register with the agency as brokers. And he's saying that can all reduce systemic risks in the market. But as usual, what government officials point to as the problem and what the problem actually is can be two very different things. The reality is, the US government debt is on track to surpass $50 trillion by 2033, and they're adding on over $5 billion to that every single day. Long story short, they're spending a lot more than what they make at a very unsustainable rate, and at some point something has to break. And like Bank of America said, central banks may simply bail out governments in coming years via QE. And so the Fed very well could go back to buying up huge swaths of treasuries and soaking up the demand that others like China and Japan don't want, and try and help keep yields low, as US debt interest repayments surge past $1 trillion at an annualized rate, and that cost of debt has doubled in the past 19 months. As the federal deficit balloons, along with rates going up, and the Treasury having to refinance so much of their debt over the next year during these high rates, when they didn't sell a lot of long-dated bonds a few years ago when they could have. And it's not just the federal government beginning to struggle with their debt repayments. We've also got millennials struggling with credit card debt, with total US outstanding credit card balances over $1 trillion. And again, interest rates at 17-year highs. And we're just seeing the 19-day delinquency rate measure for credit card holders increasing to 5.78%. And that's a pretty big increase from 3.6% a year earlier. However, some like Guggenheim are saying that the Fed is likely to cut rates below 3%, and that's making bonds attractive now. They see a recession likely in the first half of next year, and that backdrop could spark a quick Fed pivot to cut rates. And they've got them taking Fed funds rate down a bit below 3%, pausing balance sheet runoff. And they went on to say it's obviously been very painful to get to the point where we are today in fixed income markets and across the yield spectrum. They said it's kind of like the farmer who stumbles upon a burned out forest after a wildfire, and all he sees is farmable land. We're focused on, again, locking in these record high current yields, and we broadly think that's what investors should be doing too. And we can see that huge fall in the bond market in the most popular bond ETF, TLT, fallen over 55% in the last 3.5 years. And just going down to the daily chart, it may have put in a bottom late October, still yet to see, probably need a bit more confirmation and some higher highs and higher lows. And a lot of people have been piling into this, and there has been a lot of calls that the bond market has bottomed. And that seems to be the consensus. And whilst the consensus is not always wrong, it probably is a bit more than it is right. And to be honest, it's kind of hard to tell whether it is the bottom in the bond market, at least in the long-dated durations. The Fed's most likely on pause, and so a safer bet is probably the 2-year bond, and short-dated bonds, maybe high-grade, short-dated corporates that should rise when the Fed cuts. However, like I said, because of all that issuance and ballooning debt at the federal level, that adds long-term upside pressure to long-dated yields and funds like TLT. We've got some more weak data out of China, with their exports tumbling again, suggesting weak demand globally. And that's the 6th straight month that their exports have fell. And even though we've had some recent data showing a little bit of a pickup at home, got the government trying to stimulate and spend, they're still facing a lot of difficulties, especially in their property sector, and the West pulling away from manufacturing, along with the developing political economic Cold War between the states. And since we've got a weak Eurozone as well, that's adding downside pressure to oil, which we saw fall below $80 a barrel today on the back of that Chinese data. And the market no longer worried about the Middle East conflict spilling over. Seems to be completely ignoring that. We can see that in the price action of crude, just slightly below the support level I've got here at 77.50, finishing at its lows on volume. And so that's a pretty big move in the crude market at a time where there is still risks. And crude is quite closely correlated with global economic growth, so that's not a good indicator for upcoming economic growth. Even though, as Jamie Dimon says, the current conflict in the Middle East could trigger the most serious global crisis since World War II. Got a lot of military assets in the region, big build up by the Western Alliance there, along with Chinese and Russian ships. And he said geopolitical matters are very serious, arguably the most serious since 1938. He did go on to say what's happening right now is the most important thing for the future of the world: freedom, democracy, food, energy, immigration. But we diminish that importance when you say, what's it going to do to the market? He goes on to say markets will be fine. Markets can deal with stuff. Markets go up and down. Markets fluctuate. But why we do follow governments and geopolitics is it can have big effects on markets. And one of the things we're seeing in the economic Cold War between the States and China is the US, like much of the West, looking to become a bit more self-reliant and a bit of a turn back in globalization in recent years since COVID, and how China handled all that, and the threat they pose to Taiwan, with the Taiwan Semiconductor Manufacturing Company being the biggest chip maker in the world. The States has a strong political motive to onshore chip production, and we're seeing that with the new CHIPS Act, with Intel looking to be a front runner and winner from that, potentially receiving billions of dollars in government funding for secure facilities producing microchips for US military and intelligence applications. And that's the Biden administration's $53 billion CHIPS Act passed last year, with the goal of looking to increase domestic production of semiconductors and become less reliant on Taiwan and China as a whole for any mission-critical infrastructure and products. And just looking at the daily chart of Intel, had a pretty good rally from its earnings, which came in a lot higher than expected. And just taking you out to a monthly chart on Intel, up until early this year, it had been having a lot of problems and underperforming the market and industry quite significantly, as NVDA kind of overtook the lead. And just overlaying the Intel chart with the semiconductor ETF in this orange line here, you can see that huge spread and difference between the performance. However, I think Intel could be setting up good grounds for a catch-up trade on the back of that fundamental news, and the US government kind of putting the wind in their sails and looking to increase domestic production. I think this is a good tailwind for Intel, and we could continue to see a repricing in it and catch up to the rest of the semiconductor industry over the coming months or year or two. Just moving through economic data, really light news week. Saw Australia's central bank increase rates as expected, still a bit below the rest of the Western world at 4.35%. Market saying they're probably on pause for now, still a chance they may do another hike. And looking back in history, you really need a good spread in interest rates above the rate of inflation to really get on top of inflation. So personally, I think that should be a bit more closer to 5% to keep a strong lid on inflation. And just looking at the balance of trade in America, for the month of September, the country imported $61 billion more of goods than they exported, and Canada is still a net exporter, coming in above expectations, selling $2 billion more of goods than they imported. Fed Fund Futures still saying that the Fed is likely done hiking rates. Only about a 15% chance they may hike in January. But really have to see some hot CPI prints to come in for them to do that. Otherwise, the market is still forecasting a recession come May next year, with the Fed cutting rates all the way through to Christmas. Fear and greed index still a little subdued here at 41, and continue to see a bit of an uptick in corporate insiders buying, coming in at 87 purchases yesterday, but still outnumbered by sales at 133. Relatively quiet day in the options market, coming in just under 35 million contracts traded, 53% of them calls. And just looking at my institutional buying percentage indicator, still a slightly bullish at 55.26%, with S&P oscillator still a little elevated at 56.64. Okay, we'll come back to the S&P 500 at the end of this video. First, let's just move through all the rest of the other financial markets. Still a little soft in international stock indices, Canada's TSX pulling back a little bit, and the rest of the major international markets kind of just tracking sideways, no real big moves going on there. VIX is still really suppressed under 15 here, market's kind of coiling up a bit. Option dealers are really not worried, not asking for any premium above realized in their implied volatilities, and same with hedging with the put-call ratio at 0.83. So not many people buying puts here. Short-term breadth is still a bit elevated, just under 70% of stocks above the 20-day average. Actually saw a little bit of a turn down in the amount of stocks above their 200-day average at 38%. And we're back to that pattern that we've seen in recent weeks in breadth, with the amount of stocks hitting new lows outnumbering the amount of stocks hitting new highs slightly today, 32 to 28 on the NYSE and 42 to 36 on the NASDAQ. And that's not usually a sign of a healthy bull market. But mega cap tech continues to outperform. That's what's holding the growth versus defensive sectors up, along with the spread of growth stocks versus value stocks. Just looking here at a monthly chart, coming back up to those highs in 2021. However, like I said before, I think that's making for fertile grounds to invest in value stocks, small caps, dividend payers, and things like that, which have been beaten down a lot over the last couple of years. And international stocks still trying to find their footing relative to American stocks. You can see that in Euro stocks versus American stocks, and emerging markets as well, just going sideways. There's the 2-year government bond just sitting at 4.91 and the 10-year at 4.56. A lot of volatility in this, kind of trading like a small cap stock. Government bond yields. Got the dollar just kind of sitting there above 105, and Bitcoin still consolidating in this big 35,000 resistance zone. A lot of people calling for this to break out above 40,000 in the coming weeks. And a bit of a pullback in the commodity space led by crude today, with a bit of a pullback in gold as well. Got down to $19.75 an ounce. And a lot of these big markets are just struggling to break out. Bitcoin, gold, crude, just kind of all stalling out at resistance zones. Uranium seems to be holding up the best out of all of them, and agricultural commodities not too far away, but it too stalling out at a big resistance zone. Over to stock sectors, there's the cannabis ETF, continuing to hold its bounce off support. Winning sector today was ARK, up almost 3%. Overvalued stocks continue to have a really good pop here, along with IPO stocks and continued bounce in biotechs, coming off really beaten down levels. Losing sector today was oil and gas, down 2.8%, along with energy, material and gold mining stocks down as well, and a little bit of a pause in the defensive sectors. Large global shipper Maersk trading down to new lows again today, and just moving through the mega cap tech pack. You can just see how strong they are and holding up better than the rest of the market, with even Adobe breaking out to new year-to-date highs. Meme stocks were mixed. Active today was Planet Fitness, coming in with earnings above expectations. The market liked that, up 13%. And some of those defense contractors holding on to their gains after the start of the Middle East conflict. And even Israel stocks bouncing back above their 50-day, along with some continued bounces in those beaten down snack makers as well. And more softness in those old economy stocks we're continuing to watch, with the telecoms performing a bit better. And price action and regional banks still not really sure here. They did get a bit of a pop, but still on shaky ground. Okay, there's the S&P 500. Stalling out a little bit at this level, like I thought it would last week, and that resistance just below 4,400, coming up to this trend line. Volatility is really calling up. Realized is really calling up with low ranges. Although we did get the NASDAQ pop above its trend line today, but that was on below average volume. That's really just led up there by Microsoft and Apple. Once again, another skinny rally, but like we can see in the Russell small caps, They actually finished down today and still pretty soft down here. Seeing the spread in microcaps versus the S&P 500. Still really depressed. Still yet to see whether this is a low or not. Things could get worse before they get bad. However, for the patient long-term investor, in my opinion, I think there is some really good bargains out there, including the microcap I just put 12% of my long-term portfolio into. And so come back to the Click Capital YouTube channel this time tomorrow night, and I'll let you know how you can get immediate access to my 45-minute special presentation where I'll let you know this stock and do a deep dive into everything about it and present all my research to you and my thesis as to why I think it is a great buy at current levels and how it could potentially appreciate in value by 100 to 200% in the next year or two, as we've got quite a few key catalysts, along with a strong balance sheet, high quarterly dividend payments, and a management that's invested in the stock. I think you'll find a lot of value in that. And I'm offering that for just a one-time fee of $59. And like I said, if you don't think you got a lot of value out of it, I have no problems with sending your money back at all, but I'm confident that you will like what I've got for you there and find a huge amount of value. That's all for today. Thanks very much for sticking with me and Click Capital, and I'll see you again tomorrow night. Cheers.